Sticky inflation, bumper payrolls, and a divided board. Are the Fed's easing plans now in jeopardy? Welcome to Macro Matters, your regular look at what's driving the global economy. I'm Peter Devlin. The Federal Reserve's road ahead appeared crystal clear in September, but a combination of forecast beating non-farm payrolls last month and hotter consumer prices has shifted the Fed rhetoric back into wait-and-see territory. As markets pull back their rate cut expectations and with more storms on the horizon, what's the path ahead for the Feds? Well, to help answer that and more, I'm joined by Gregory Daco, Chief Economist at EY Parthenon. Welcome, Gregory. So starting off with the latest mixed inflation prints, CPI was higher than expected, rising for a second straight month, while PPI today was unchanged in September. So what does this tell us about the inflation outlook, and are stagflation alarm bells ringing?
No, I don't think stagflation alarms are ringing. Right now, what we're seeing is that there is bumpiness in some of the inflation data, but the underlying fundamentals continue to point towards disinflation momentum. If you look at the headline CPI print for the month of September, it was the lowest print since February of 2021 at 2.4%. So we're still on that disinflationary trajectory. And the same can be said for producer prices. Producer price inflation is back in its pre-COVID range, which is very reassuring. So from an inflation perspective, I wouldn't be too concerned when it comes to Fed policymakers being alarmed by any reacceleration in inflation.
So you did flag in your notes that the inflation risk from rising tensions in the Middle East is pressuring oil and gasoline prices, but as well you did flag that the Fed's pivot away from data dependency. So will policymakers ignore spikes in inflation?
Well, I think they have to be very careful with spikes in inflation because we're coming out of an episode of very high inflation that we hadn't seen in multiple decades. But in the context of the tensions in the Middle East, any type of spike that would come from higher oil prices filtering through to gasoline prices and transportation costs would likely be seen as transitory. And therefore, the Fed would not necessarily raise rates to offset that because we know that higher oil prices, higher energy prices tend to lead to demand destruction. So they would likely err on the side of caution, perhaps easing a little bit less rapidly than what they had intended to do, but not necessarily tightening monetary policy, which would be counterproductive and further hurt economic activity, which is the very thing they want to avoid in this environment where we're seeing a gradual, gentle easing of labor market dynamics and cooler economic activity.
So keeping with the labour market there, a tug of war is mounting between the Fed's dual mandate, price stability and full employment. You did highlight that Hurricane Milton is coinciding with a critical payrolls survey week that is muddying the employment picture. Can you explain the potential problems ahead?
Well, the risk with any type of natural disaster is that, of course, there is a significant trail of destruction and there are massive disruptions to economic activity. But importantly, as well, for economists and policymakers, it leads to a muddied picture when it comes to economic data because surveys are disrupted or because people are unable to work because of the poor weather conditions. So as we look ahead to the next Fed meeting, we will have another payroll report that will be highly will grab a lot of attention, but that picture will likely be muddied by disruptions from Hurricane Milton, as well as from disruptions from a number of strikes that occurred over the course of the past month. So it will be very delicate for policymakers that are too data dependent to focus just on these numbers. And that's why I've argued for more of a forward-looking perspective as to how fundamentals are evolving on the inflation side of the mandate, as well as on the employment side of the mandate.
Well, comments from Atlanta Fed President Raphael Bostic, he did speak to the Wall Street Journal yesterday, was open to skipping a rate cut in November. Could we see more dissent among policymakers away from Powell's influence?
Well, I think what we saw in the FOMC minutes was that Fed Chair Powell had a tremendous degree of influence over the decision for the Fed to go with a large 50 basis point rate cut as its first rate cut. The minutes indicated that there were some participants that would have voted for a 25 basis point rate cut, but agreed to go with Powell for a larger rate cut. That influence is increasingly being seen with New York Fed President Williams as well as others amongst the FOMC, that are arguing for more of a forward-looking, risk management-based approach to policymaking in an environment where inflation is still moving lower and where employment risks are more balanced than they were a few months ago. So that's the direction of travel, easing gradually as we navigate into 2025.
Gregory Daco of EY Parthenon, thank you very much for your thoughts. And that's Macro Matters. Don't forget you can watch more videos on Reuters.com.